TheoTRADE. This is Don Kaufman. It's November 17th, 2023. Just about 25 minutes stands between us and the weekend. S&Ps at present time, massively unchanged. I got to tell you, that's pretty much sums up, well, the entire week. Well, the entire week really came down to what? CPI. CPI came out, the market actually spiked, and it was over from there. So we're going to cover that and considerably more here on this weekend's update. Is a severe recession imminent? All right, so I caught a lot of people probably off guard with that title, because if a severe recession is imminent, why is the marketplace doing nothing but going effectively straight up? Look, there are signs in this marketplace of a recession being imminent, ugly signs, which we're going to cover here. In fact, Blake Young covered some of that, okay, in last night's video. I'm going to hit this from a bit of a different direction. Nevertheless, okay, it really does beg the question, are we pricing in right now a recession? All right, let's get right down to it and start with the first bullet up here, which is CPI. It's what I call CPI and the 2-minute week. Why do I say that? Because lo and behold, if I actually break this down, let's go to the 30-day 1 hour to begin with. This is a 30-day, again, a 30-day 1 hour, but I'm zooming in. And again, these are 1 hour candles. If you take a look at Monday, what happened on Monday? Boo, absolutely nothing. Tuesday overnight, dead. CPI comes out, bam, we're to the upside. Rest of the week, absolutely nothing. So on Monday, we had massively unchanged. Tuesday, we popped to the upside. You got Wednesday, Thursday, and Friday with absolutely nothing. It's why I call it the 2-minute week. In fact, to kind of further that, you want to see what I mean by 2-minute week? It really has been the 2-minute week. We come over here and go 5 days to 1 minute, right? So we're actually looking back in time, right? Just taking a quick glance. Oh, there it is. Okay, your entire week inside of 2 minutes. Yes, this is now 1 minute candles, and we traded from 44.20 to roughly 44.80, which is a 60 handle move. Literally, that's the range, 60 handle move inside of a whopping 2 minutes. There is your 2-minute week. And the reason I call it a 2-minute week, take a look at the SPX, the mother of all products. And the SPX, you were pricing in basically a $63 move in the week. Now, yeah, we're slightly outside that, but yeah, the truth is, okay, look, Monday, nothing. Tuesday, pop to the upside. Wednesday, Thursday, Friday, absolutely nothing. And people, that was your entire week. You know, if you want to sit here and like recap the whole week, you got to go product by product by product. But that is what spiked the S&Ps. That's it. That was your entire move. And there are some interesting aspects of this. So if you look at the, this is the SPX, which is outside the expected move. But let's actually jump over to the QQQ, the Nasdaq. If you look at the Nasdaq and pull up auto expected moves, it's basically at the upper edge of the expected move. And then this is interesting, the IWM, which we're going to bring this up again in a moment. IWM is like 2.5 sigmas. This thing is Mr. Toad's Wild Ride. I mean, on Monday's the only time we traded inside of the standard deviation. Everything else is just, okay, unrealized volatility. Anyway, with that, so CPI is the entire week, okay? Everything after that has been null and void. Now, okay, let's jump to it. Severe recession. Now, I'm not looking right in front of us, meaning that, you know, a lot of the times when we're talking and trading here, we're looking right in front of us. Okay, one of the things that really did bother me this week unequivocally is oil. So if we take a look at oil, in fact, you can look at oil and you can look at expected moves and so forth, and oil has had a significant bounce today, but the energy complex itself, it's all over the place. And even though energy, okay, this is the energy complex, the XLE, it is finishing the week not only higher, but towards the upper edge of its expected move. It happens to be the overall price action in oil that is very, very disconcerting right now. Okay, and what this basically screams is, you know, was oil overpriced? I think you could probably make that argument. Okay, but this is now screaming like economic slowdown. Supplies obviously are building, demand is waning, whatever you want to call it. I don't care what you want to call it. Okay, there's a problem right now in the oil markets. Energy is not categorically, like seeing sell side like this, not bullish for the overall economy. And maybe that's a little bit here in the US, but maybe it's heavily in China. So with that, I bring up like FXI, which is actually the Chinese large caps. Chinese large caps, they're being supported specifically by China, but they're still down about 11% on a year-to-date basis. All right, come back to that. So oil into itself, I think is ominous. Now, it doesn't necessarily mean ominous for the S&Ps right here, right in front of us, but it's ominous, right? Okay, because somebody's supply is starting to grow, and that's oil, which means the economy is not actually rocking maybe like you thought. But you have to put that on a global scale, to put some perspective. Let's get a little bit more here in the U.S. Here in the U.S., we're seeing bonds rally. Now, you can call this a knee-jerk reaction, and I think that that's actually a valid argument, meaning that, yeah, bonds are rallied, but maybe they're going to sell back off, okay? Bonds rallying right now, right? I don't look as being a positive economically. Bonds rallying are basically saying, well, eventually the Fed is going to cut rates over here, although the Fed is saying something very different, okay? The market right now is starting to really price in a rate cut. That's right, not a hike, but a rate cut is being priced in June. People, okay, just a little bit over a year ago, we saw the exact same stuff. They're like, no, they're going to hike, and now they're going to cut. They were thinking that they were going to cut, okay, in early 2023. By the way, we're in 2023 right now, and we've been hiking. So, yeah, right now, though, the bonds clearly see something economically going on, and it is a little bit disconcerting. Now, I'm not going to make any forward-looking projections specific to the bonds. Okay, if I were, and again, I'll give you my opinion, but when I say I'm not going to give you any forward-looking projections, okay, I look at this as this one's a complete toss-up. Instinctually, I would look for this market to actually turn back around based on what the Fed is going to say. If there's any positive data out there, any positive data, because some of the data coming out this week, not really positive, like retail sales. We're going to talk about Walmart and Cisco and Palo Alto Networks. Okay, there's a couple of stocks that have actually warned right now, but too early to tell. And when I say positive news, if there's positive economic news, the bonds will sell back off. Okay, if there's negative economic news, the bonds are actually going to rally up as, again, not only the markets may get a little defensive at that point, but interest rates start actually going down. Remember, interest rates going down is the ZB rallying. Moreover, if you take a look at the TNX, this is the 10-year, okay, and the 10-year has actually gone from basically 5%. It's gotten crushed the last couple of weeks. Like, I'm not going to sugarcoat it. It basically tagged 5%. It hit that marquee level on the button, people, on the button. Exactly a month after, though. Okay, we're basically a month after. It's already down basically 4.4%, which is crazy movement inside of the 10-year. And again, in my opinion, I'm not sure we're done in here. Like, this thing may have to soar to really put, the fear into this marketplace. So as I was saying, and questioning a severe recession, oil really bothers me. Bonds, I'm still very, curious as to the future of bonds. In fact, I covered all of my bond positions. I'm not presently carrying any bond positions right now in any of my portfolios because, frankly, I don't have that feel. I want one. I just do not have one right now. And as a trader, you got to tell somebody, hey, like when it's going to be a little bit of a toss-up out there, again, instinctually, I believe that the bond's maybe not done and that 10-year has got to crack through that 5% to really pummel that marketplace. But we're not home yet. I mean, looking at the dollar right now, okay, a dollar has had a precipitous sell-off. And, throughout the course of this, all right, was really, pressure, it's inflation. This looks, okay, this is what disinflation, deflationary, whatever you want to call it. The dollar actually falling right now, though, okay, initially is a positive, okay, for inflation cooling, and then very rapidly can become a negative. And that's why this whole market right now, and it's big catch-22. It's why I'm questioning about a severe recession. There are some funky things going on right now. And if you are confused, not only aren't you alone, everybody, okay, trader, investor alike, if you're not confused, you're not paying attention. Then you start getting details, and I'm just leading right into it. Then you started getting details from companies like Walmart, okay? I don't know about you. I listen to Walmart. I listen to Walmart a lot more than I listen to Target, and I'll tell you exactly why. First of all, okay, Walmart was up 18%. What did they do? They warned, and they specifically said, retail, it's getting sketchy, okay? Basically, they're saying the consumer out there, they're buying more like staples, like food, okay, items, discretionary items are not necessarily being bought. Now, there's a conflicting report, of course, from Target. But can you listen to Target? Target was actually heavily engrossed inside of a scandal. The stock pops back up. It's still down 14% though on a year-to-date basis. So the way I look at Target is they suck just a little bit less right now. They're still not performing though incredibly well. Moreover, Costco, again, I pay attention to this. Costco took actually quite the little hit after Walmart's snafu around earnings. But Walmart is actually guiding right now a little bit lower. This is a fairly precipitous sell-off. Again, I do, in fact, carry short positions inside of Walmart at this point, and I'm back to basically even on some of those positions in there. Now, Cisco. Let's actually talk about Cisco. It's old guard technology. Okay, the reason I wanted to bring up Cisco, a significant drop this week, they guided lower. The reason I'm bringing it up, not because it has any material impact to the marketplace whatsoever. And it's so ironic. By the way, Cisco's now flat on the year. It's so ironic that I'm saying that because Cisco is still basically a $200 billion company with no material impact. Moreover, okay, I also want to point out Walmart is a $400 billion company, no material impact. And you go, how can they not have a material impact? Oh, because nothing matters but 7 stocks. And that's it. Nothing matters but 7 stocks. But you really do have to start to pay attention when stuff like Cisco. Cisco is networking, okay? Which basically sells, networking to every major tech company out there. I mean, if you're involved in the internet, if you use it, you probably rely on Cisco for something in some way, shape, or form. If not them, okay, I think you can make an argument that Palo Alto Networks, okay, also had a fairly wild move, a little bit of a bid back to the upside, but some heavy volatility in here. But Cisco is definitely concerning. Moreover, okay, you can call this a one-off, but and it is a Chinese company, but Alibaba Group. Now, this is one of the things that I say coincides a lot with some of the movement inside of oil. Okay, Alibaba, though, taking a hit, needing some restructuring. Moreover, okay, saw a big hit in BIDU revolving around this as well. Okay, BIDU, though, down substantially already. Anyway, onward and upward, I already showed the FXI on that particular front. Okay, what I'm trying to point out, though, over here, there are definitely some disconcerting areas of places that you really do need to pay attention to. Look, we can always find stocks that go down. I can actually show you other stocks that are flying right now, like Ross Stores, right? Ross, okay, actually sells off, huge bid back to the upside here, up some 7%. Okay, I can bring up again a number of individual retailers that have had spectacular moves like Gap. Okay, and this is very, very much discretionary. But with all due respect, okay, stocks performance over the last couple of years has been dismal. Okay, in some of these stocks, absolutely abysmal inside of Gap, and then it finally pops back to the upside, still down almost 20% over the last 3 years. Nevertheless, okay, Walmart, you do have to pay attention to. It doesn't matter what you think, you have to. Cisco, you got to pay attention to it. Okay, it's old guard tech, but it's still tech. It's just not one of the 7, okay, that influence everything. Speaking of one of the 7 that influence everything, Microsoft, sell side activity. No follow through though whatsoever inside of Apple. Okay, can you believe though that the Nasdaq is only down 23 handles? Microsoft though is down 2%. Why? It's just going to be covered up by the fact that Amazon is actually bid today. Nothing's down really huge other than maybe Microsoft at this point. But we have to pay careful attention at this point in time, specifically, okay, around other stocks that are starting to warn, if you will, about the possibility of an economic downturn. All right, spin it around, switch gears a little bit here. I actually wanted to mention VIX. There's so many people talking to me about VIX. The VIX is dead, man. The VIX is dead. Let me tell you right now, if you're still looking at the VIX, okay, it's archaic. You got to stop looking at the VIX. I'm actually going to explain why here in about a 2-minute synopsis. The VIX can only see options that have greater than 9 days remaining to expiration. If you actually look out, look with me here, 27 days out, okay, and we're actually going to open up volume. Okay, here, let's just open up volume on the 14 most active strikes, which are near the money strikes. The volume, there is some volume. Okay, there is some volume in there, but it's pretty nominal. Then let's actually look at 0 DTE volume. Oh yeah, 55,000 contracts of the at the money, 80,000 contracts on the puts, 80,000 contracts, 100,000 contracts. It's insane. Do you realize that VIX can't see those options? VIX in the equation is a 30-day time-weighted average. So if you're looking at VIX, you got to look out to options that are like 30 days. They're not even receiving any volume. The VIX, is an archaic instrument. You got to let it go. Okay, it's broken. It's a broken metric at this point. And one of the things that I keep stressing, you better be looking at weekly expected moves. If you're not, you're a dinosaur in this business right now, because look what's going on. The breaches week in and week out of expected moves, which is, unequivocally, the options market is doing a terrible job of handicapping forward risk. No other place screams that more than if you take a look at the IWM and the Russell, and bring up auto expected moves. Look at the breaches in here. They're ridiculous. By the way, I want to make something very clear. See, this is an expected move here. In fact, you know what? I'm going to zoom in because it's that important that you guys see this. This is an expected move here. That's where we ended up that week. We ended up, it's like 2 sigma moves, 3 sigma moves every single week, week in and week out. And the crazy part, of the IWM, the craziest part of the IWM, if you look down to the bottom of the screen, the implied volatility is inherently low, but the historical volatility is through the roof, And again, what am I pointing out? You're like, how does that relate to the VIX? Because that 30-day volatility, which in this case would be considered RVX, RVX is actually Russell volatility is at 20. I want to see something really crazy. So RVX is basically at 20. Let's actually pull up RUT. RUT's the same thing basically as IWM, all right? Pull up the RUT, come over here to studies, go add study, go to volatility studies, go to historical volatility. Do you realize the historical volatility? It's at highs this year. I mean, basically, if I open it up now, even for 3 years, look how high price action is in the Russell, Price action of the Russell is basically at 20. And again, I want to make sure everybody sees this. Price action of the Russell is rounding up to basically 28%. But the RVX, which is basically Russell, like 30-day volatility, has it pegged at about 20%. So actual price movement, averaged over the last 20 days has been 28%. But the forward future of it, it's just terrible. It's doing a horrific job of handicapping forward risk. And I can't stress this enough to people because they're just not getting it. They're not picking up on it, And you need to pick up on this in a big way. The VIX is a broken metric. Use our weekly expected moves wherever and whenever you can, because right now in the short duration, you gotta be a buyer of options. Killing it on an intraday basis, being a buyer of options when, that movement happens all in a short period of time. Maybe that's not exactly useful, but look at this. The IWM's all over the place, It has been spectacular trading inside of the Russell. All right, last but definitely not least in here, we do have to look at SKEW and then, of course, SPX once again. SKEW is high flying, right? What does that imply? Out of the money puts versus out of the money calls specific to the SPX. We have a decent amount of SKEW in play right now. It's one of the highest levels of SKEW that we've seen this year. It's right up here in accordance with some of the SKEW that we saw in 2021. And what's interesting about that is in 2021, what was the market doing? It was straight up until it was straight down. But the SKEW is absolutely rocking, and it has opened up the Christmas tree spread again. Think about that. We're coming into the holiday season. It's lovely. And yet the Christmas tree, once again, becomes a trade of choice. Last up, we are actually looking at Thanksgiving week. Thanksgiving week is filled with, 3.5 trading days. You've got Monday, Tuesday, and Wednesday. Those are full days. Friday is going to be a half a day. Obviously, Thursday, which is Thanksgiving Day, is football, turkey, and that is it. But Okay. We are open a half a day on Friday. I reiterate that. Right now, we're looking at about a $50 expected move. There is still a lot of news, though, that's due out next week. So you can't completely fall asleep at the wheel because fall asleep at the turkey wheel. The fact of the matter is, you still have actually like a couple of bond auctions. You've got durable goods coming out. Okay. And you've even got like FOMC minutes. It is going to be chock full. FOMC minutes are actually coming out on Tuesday. The durable goods are coming on Wednesday. By the way, you even have ECB minutes, I believe, coming out on Thursday, which the markets are closed. And to round out the week, yeah, some more retail sales numbers. It is again still filled with announcements out there. So yeah, get ready. A little bit more volatility headed our way in this next week of trade. But the big thing to watch right now, it's no question, still going to be watching oil, but the bonds. Okay, unequivocally, it's the bonds that I'm watching the most because this week, nothing definitive comes out other than a little bit of a rally back to the upside over here. You know, again, inflation's kind of coming down, and that's a bit of a catch-22 because if it's, deflation, then we're actually looking at a recession, could be a severe recession, given the fact that oil's getting hammered. Watch those bonds into this next week of trade. Thanks everybody for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.